Welcome to the new and improved Mortgage Monday. I'm David Greene. He's Christian Batchelder. We are the OneBrokerage. And just like the Autobots that are here to fight against the evil Decepticons of the loan industry, we are here to protect you, your real estate, and your pocketbook. Christian, how are you today?
I'm doing good. What an intro. Optimus Prime coming at you live on a Monday, huh?
Autobots, roll out.
I love it.
So it's been a while since we did this. If people were wondering where we've been, Mortgage Mondays has now been moved over to the David Greene Show. So you're here, you're on my YouTube, you're hearing it. If you care about other people, if you're a good human being, go ahead and tell them, hey, you guys need to subscribe to this channel to catch Mortgage Mondays, because we're going to have a Mortgage Mondays episode coming out every single Monday, and in the future, a Finance Fridays, because alliteration, of course. We're just waiting for Christian's schedule to accommodate that, because this man is busier than a one-armed wallpaper hanger. How many refis do you think that I've sent you, and then how many total do you think you've talked to just in the last 7 days?
150 people probably in the last 7 days.
I don't doubt
they're interested in dropping the rates or cashing out, or just kind of getting an idea of what the market's doing, right? Obviously with the Fed pivots and everything going on in our economic environment. There's a lot of re-interest that's being sparked, right, in the real estate industry for sure.
It's feast or famine in our world. It's either we have so many clients that we don't know what to do trying to buy a house or trying to get loans, and everyone's mad because they want more time and more attention and more support, or it's famine. There's nothing to do. Our staff is like, I need something to do. Everybody needs something to do. We're reaching out. We're trying to find ways to get people interested. The real estate industry tends to move all at the same time. Everyone's buying houses or nobody's buying houses. This is why I've often said buyers drive markets. And on this show, Mortgage Monday, we talk about the things that affect buyers, namely the financing of real estate, because usually the price you're paying for it and the loan options you have dictate if you do buy real estate. So it's nice to have you back again. I see you combed your hair and put on a collared shirt for us. We're both in one right now.
Big moves right there. Big moves.
Yeah. I feel like we're Harry and Lloyd at the party right now, where one of them had on a blue suit and the other one had on an orange suit in Dumb and Dumber. And that it was like a owl fundraiser. Remember? You've seen Dumb and Dumber, right?
I have.
Just sitting here putting out the vibe. All right, let's get into it. Today's episode is all about refinances, because as you mentioned, the Fed has lowered rates. The lending industry has heard and anticipated this. Rates have come down. They've come down even more, I believe, than when they first came down. As of the time of this recording, where is a primary residence interest rate sitting?
We're starting to get towards 6. I'd say probably 6.25, 6.5 range, depending on your credit score. But we're quickly approaching really the flat 6, even below 6s for some, significantly experienced and well-qualified clients. That's for conventional primaries. Investments about 1% higher than that, so 6.5, 7 range. And that's actually right around where DSCRs are as well. So pretty much anything across the industry, if you got like a 7.5 plus, reach out, start thinking about a refinance. Could potentially save quite a bit on your monthly mortgage expense.
I'm going to say that differently. If you're at, what'd you say, 7.5 plus,
yeah,
you'd be a fool not to reach out to Christian or I. He's going to give his information at the end. You can get my information from my Instagram page, but do not be dumb. If you're at, I'd say even like 7 plus, but definitely 7.5. I think, Christian, you're probably saying that because you're buried right now and you're like, man, I'm trying to keep up. My thumbs are bleeding. David's keeping me in this sweatshop. He won't let me leave as he's typing on his keyboard. But we are frantically trying to save people as much money as we possibly can on their mortgage. So in today's show, we're going to be talking about what is a refinance? What are the types of refinances? How do you know when you should refinance? And we are going to blow through this thing. Just remember at the end, if we intrigued you, if we caught your attention, if you even had a thought, not only leave a comment, but make sure you reach out to Christian at the end, get on his schedule and get a free consultation about how we can help you. So let's start off. What is a refinance and how is this different than a purchase?
Yeah, refinance is funny because a lot of people have this idea of what it is. Refinancing is just replacing one existing mortgage with another. Now, technically, when you refinance of a paid off property, it's still a refinance, even though there's nothing to refinance, right? You're just refinancing a zero balance mortgage at that point in our eyes. But it's any time you already own a property and you're taking out a new loan against it, whether you're paying off your existing loan, whether there is no existing loan, or you're getting a second mortgage on top of your existing loan. All of those can be considered a refinance.
Okay. So You've already got a loan. You're trying to get a better loan, which is funny because they're very similar to buying a house. It's just you're getting a loan and you're paying off the loan you had, or you're getting a loan and you're paying off the loan that the previous seller had.
That's
it's
right.
Kind of the same thing though, right? Now, is there a difference in the interest rates when you're refinancing versus when you're purchasing?
Typically, yes. Now, this is where we need to dive into the refinance options. There's two main types of refinances. There's what we in the industry call a rate term refinance. Don't worry about the fancy word. It just means you're not taking out cash. You're just getting a new loan to either change one of those two things, your rate or your term. So some people refinance a 30-year fixed into a 15-year fixed. That's just a term refinance. Some people refinance, like we're saying, a 7.5 down to a 6.5. That's a rate reduction refinance, right? But all those are grouped together as rate term. Those are typically very, very similar in interest rate compared to mortgage purchase financing. Where you do get a difference in pricing is a cash out refinance. That's where, let's say you have a $500,000 mortgage. We're now getting you a $600,000 mortgage. You're paying off the 5 and you're pocketing the 100,000. That would be a cash out because cash is coming out of your property and going into your pocket. Those are typically not significantly more, but usually slightly more, within a 0.25% different of where a purchase mortgage or a rate term refinance would land.
All right. That's actually really helpful definition there. So if you are refinancing a property and you're getting a lower rate or you're getting a shorter period of time or a longer period of time, you get a slightly better interest rate than if you're refinancing for a higher loan balance than what you currently owe. You're taking cash out. For some reason, lenders consider that to be riskier. I have no idea why they think that. It's never made sense to me. Is there any logic behind it that you've recognized?
Yeah. The technical reason is that just obviously this doesn't apply to like if you cash out and then invest. Our kind of bubble that we see it in, it doesn't make sense because usually when you cash out, you have a plan for the cash out. But you have to realize cashing out takes everybody into account. So like this is the guy who's owned his property for 10 years, who's now out of money, who lost his job, who needs to cash out in order to pay his monthly expenses. Cashing out includes all those different types of people. And on average, somebody who's comfortable and stable enough to purchase a house is probably in a little bit better financial position than somebody who needs to get money from the property they already own, which is why banks price it a little bit less aggressively because they know, hey, people are willing to pay a little bit higher percentage on the interest rate in order to acquire some of that equity out of their house.
Solid point. I never thought of that. I'm going to go on record here and say this is the first time I think that we've been doing this podcast, and you had an idea that I've never even entered my mind before. So
hey, I'll take
well
it.
done. This is why we call him the Lone Ranger. All right, moving on. When there is a refinance, are there any out-of-pocket expenses?
Yeah, that's a good question. And this is really, really, really important because if any of you guys listening to this have a mortgage, you're either about to or you have already started to get solicited for no-cost refinances. No closing costs, no fee refis. We'll roll it all in, all the different crud that lenders roll out during what in our industry is called, kind of like David explained earlier, the boom or bust. Refinance booms are the boom period, right? That's where a lot more people are interested in mortgages. You get refinance business. So there's a lot of marketing that goes into it. And there's a lot of ways to make it sound like different than what it actually is. And what I mean by that is, David, you hit one of the most obvious ones, no cost refis. To explain this as well as I can, there's two main ways that a lender could accommodate for this. Number one, it could mean no cost out of pocket, which means you don't have to have a dollar go from your bank account to the lender. Well, how can a lender do that? It's obviously a fee. It's a service. Somebody's getting paid to do your refinance. So number one, they can just roll it into your loan. So let's say you have a $500,000 loan and there's $5,000 in fees. Instead of getting you a $500,000 loan and collecting $5,000 from you for the fees, they just get you a $505,000 loan. That's called rolling into the mortgage. Some lenders may consider that a no-cost refi because no money left your account and went to the lender. It's not really a no-cost refi. You had $5,000 in fees, right? The alternative is when they get you a lender credit to offset that $5,000 in fees. Now, that sounds great. The lender paying your bills. Everybody loves the image that probably brings to mind. But it's not always rainbows and butterflies. A lot of times you're taking a higher interest rate than you would have gotten otherwise in order for the lender to generate that $5,000, right? Lenders are not in the business of just giving away free money. So typically they're getting you a little bit worse deal on the loan that makes the loan sellable at a higher profit to enable them to give you that $5,000. Are you really getting a free refinance at that point, or are you paying for it with a higher interest rate? Right? If your loan officer isn't having these conversations with you and you just responded to a cold call or a mailer that you got, have these conversations with your lender, right? You can talk to us. Our consultations are free, but no cost refinances are very seldomly a no cost refinance. Typically, there's going to be some negative to receive the benefits of a refinance.
Solid point there. All right. This is one of the reasons that I started talking about in my book, Pillars of Wealth, understanding that wealth is energy that is kept in different forms. We typically only think of it in two forms: the cash you have in your wallet or the savings or checking account you have in a bank. We are used to that. We typically call them both cash, even though it's typically held in different forms. But equity in real estate is another form of energy that's being held. So is money held in a stock portfolio, or money that's held in a car that you bought. The car tends to depreciate over time, so it's a poor storage of wealth, but it still is storing wealth that's bleeding over time. When you understand how to look at wealth this way, it becomes easier to understand what you just said there, Christian. When you are told it's a no cost refi, it is true that it is not money coming out of your bank account. However, if you had $200,000 of equity and you refinance it and your closing costs are $15,000, even if you still only refied the exact amount that you owed, like a rate and term refi to get a better rate, your loan balance went up by $15,000. So you owe more money on the property. That's in some ways the same as spending $15,000 of cash. In some, it's even more expensive because that extra $15,000 that you borrowed has an interest rate attached to it. Now, that doesn't mean don't do it. It just means understand there is no such thing as a free lunch. A refi is going to cost you something. In most cases, it makes more sense to borrow the money because rates are still pretty low. They're not at 20%, 30% here. But in other cases, it might make sense to pay the cash if you have a lot of money. Now, this begs the question, because there is a cost to a refinance. How do you determine if the cost of the refi is worth the lower rate that you could get if you're refinancing from the 7.5 that you mentioned to the 6 or maybe even a 5.75 they can get if they buy the rate down?
100%. And this is what we take people through when we do a refinance consultation. It's not just let's do a refinance because you can drop your monthly payment $250, right? It's never that clean. It's, hey, if this costs, let's say $5,000 today to get this refinance, and you're shaving off, like I said, $250 on the mortgage. How many months of saving $250 does it take you to recoup that $5,000? In that case, rough math, 20 months? So that would take you about a year and a half, roughly, right? Well, number one, you can ask yourself, what kind of investment yields a year and a half, 100% ROI? That's pretty good, right? But is that something that you want to take on right now, right? Do you want to pay more fees? Do you want to up that to $7,500 or $10,000 in closing costs to potentially get a year turn time, right? And that's what we call running a break-even analysis. How we have to analyze how long of saving the difference in your monthly payment until you recoup the cost of a refinance. And only once you get that information can you really make an educated decision. It's not just, it doesn't cost me anything right now. I'm saving $100 for free. I promise you guys, no matter how much your sleazy loan officer is trying to sell you that, it's not true. There is something associated, whether it's a higher interest rate or an actual charge that you're receiving, there is something you are paying for your refinance. There's no such thing as a free lunch, like David said. That doesn't mean it's a bad idea. It could absolutely make sense to refinance. I've refinanced properties. David has refinanced properties. Every real estate investor, if you've been doing it for 5+ years, has probably refinanced, right? You just have to knowledgeably refinance. You got to know that you're doing it correctly. You have to understand your break-even times, because if you don't, David, where we're probably going with this is what happens if rate keeps coming down? You're going to refi again. Does that mean you lose all the closing costs that you paid for on your first one? Maybe. That's why it's important to analyze and know what you're doing accordingly.
That is where we're going with this. But before we get there, I want to make sure I understand what you're saying for our listeners. So let's say that I could refinance and I could save $1,000. No, let's make it $500 a month on a refi. That's $6,000 a year. And if it's going to cost $12,000 in closing costs, that's going to be added to my loan balance, but I'm going to save $500 a month on this. That's a 2-year break-even point, because I'm going to be saving $6,000 a year and it was $12,000 to do it, correct? So what we would say is if you're going to hold the property for 2 years and a day, it makes sense to do this refinance. If you're going to sell it in less than 2 years, then either don't do it, or maybe you refinance it into a higher interest rate, but you get a lender credit. And so you have lower closing costs. And we can kind of play with that, which is what the loan expert's supposed to do. And that's something that makes the One Brokerage different than your standard loan officer. Put simply, your standard loan officer is a shark. They want to close your loan at any means necessary. Whatever it takes to get you to sign on the dotted line and get you in there, they're going to do it. They're going to quote you a really low rate with really high closing costs. They're going to tell you all the reasons you should refinance and none of the reasons that you shouldn't. They're going to do everything that they can to get you in as deep as they can because they don't make any money at all unless you refinance. Now, our mentality is different. We have a reputation that we want to uphold. We also want you not only to refinance with us for the next 30 years, we want you to purchase with us for the next 30 years. We want your friends and family to come to us. We're a referral-based business. We're not a shark that's just trying to eat that thing, kill it, and move on to the next thing where they're always hunting. When we're like a farmer, we're trying to grow these trees that produce fruit that come back again. So instead of trying to learn everything you can about loans on your own, reach out to Christian, let him connect you with one of our people, or let him work with you himself. We'll figure out what the best option is, and we will guide you and consult you and then educate you in the process of the right way to go about this so you can build a portfolio similar to how we did. Now, moving on to the last question there. What happens if I refinance and I save $500 a month and it costs me, say, $9,000? So my break-even point is an 18-month. It seems like a no-brainer there. But rates drop again. Now, a couple scenarios before you jump in there. Rates may drop, but not a ton. So they inch down a little bit. Refinance doesn't make sense. Rates may drop a full point. I may want to completely do another refi. How are you going to be guiding people whether they should refinance a second time, whether they should wait to see if rates are going to keep going down? What's the brain of Christian like here?
Yeah, there's really a lot to unpack here. And honestly, we could have a 3-hour Mortgage Monday episode about this. And we can if you book a consultation with me. We could have one-on-one Mortgage Monday. But really, it comes down to kind of a concept that you hear a lot in stocks, right? You kind of get towards timing the market. And you hear that in buying everything, right? Used cars, stocks, real estate. Everybody wants to time the market perfectly, of course, right? Just like we all wish we bought in, David, when you picked up your 2 Hawaii condos, we all wish we went and bought in Hawaii at that time, right? You slam dunked it on those deals. However, what I always give people the advice on is do a deal that objectively benefits you and makes sense right now. Okay. So if the going market rate, if you're at a 7.5 and you can get a 6 right now, that is almost assuredly going to be a slam dunk win. Your counter to me is, Christian, what if they're 5% next year? Then we reanalyze and we say, how much of the expense of this refinance have you not realized yet? So like David said, if we're on an 18-month break-even period, now let's pretend we're now 12 months into that. Rates are a full % lower now. You haven't held the loan long enough to realize the savings of your first loan, but now you can get down to a 5%. Is it worth sacrificing your last 6 months of saving on your first mortgage to double down and save on your second? Maybe. That would just take another analysis, and I have ways and algorithms that I can plug that in and say, hey, we're accepting that we mistimed our first refinance. You still save some money on your money. That's still good, but does it now make sense again? And I mean, doing this as long as I have, I remember people back in 2015, 2016, 2017, I was doing refis for them. And I have some people that literally refinanced in 2016, 2017, 2018, and 2019, and ultimately ended with their COVID interest rate, right? From 2019, 2020, obviously they didn't touch it after that. But I have people that systematically refinanced. Was there a little bit of money left on the table if they just waited for 2019? Maybe. But they still made sense each time. Hey, if you're only at a 12 to 18 month break-even period, it's not bad, right? Like even if you have to shave off a couple of those months towards the end of it, it can absolutely still make sense. And you can, just like I said, systematically go through the market. And you may not time the absolute peak, but that's like, are you never going to buy Apple stock because it's not $4 a stock? Of course not. You didn't time it when Apple IPO'd, unfortunately, but it could still make sense to buy Apple stock, right? And it's the same concept here, right? You don't need to overthink it. If there's an objective benefit that you see saving 250, 300, 500, depending on your loan amount per month, and it makes sense with your new loan amount, I would say reach out. We can analyze it. But more importantly, if it doesn't make sense yet, if it costs you $20,000 to save $200 a month, that's a 10-year break-even period. Don't do it, right? But could we then put you on a tracker, which we do at TheOneBrokerage, of, hey, this may start to make sense once rates are at 5%. They're not there yet. Okay. We'll give you a call once they are if you just reach out and establish the conversation now, and we can let you know, hey, rates are starting to approach that point that we set where it starts to make sense to look at a refinance, right? And now that's not a promise that they go that route, right? You're kind of saying, hey, I'll buy Apple. That's like a stop loss in stock, right? You buy it once it reaches a certain point. Not knowing that it will go there, that's something that we can definitely put into place for you, right? And the moment it does happen, we give you a call, say, hey, let's get a refinance going, right?
Yeah, that's a great point. When you were talking, I was kind of thinking in my mind of what type of picture do I come up with to understand how to look at this. And let's say that you were at an 18-month break-even point. You're going to save $500 a month. That's $6,000 a year. And your refinance costs you $9,000. So 1 year in, you've saved $6,000, but it costs you $9,000.
Yep.
So you're $3,000 short of breaking even, and you got an opportunity to refinance and save another couple $100, right? There's a couple ways to look at it. In most cases, it would make sense to refinance again, because you're just kind of extending that break-even point, but it's still going to be there. You're just pushing out a little bit longer before you break even, but you're going to be saving money for the full extra, 28 and a half years.
It's compounding savings at that point.
There you go. It's really important. You could also look at it like, well, I'm $3,000 short. I could refinance again for $9,000. So now I'm in this position where would it make sense to refinance again at $12,000? Because I'm $3,000 short plus the $9,000 to do it. It just makes my break-even point a little bit longer. In most cases, you're going to hold the property more than that period of time. So the answer is yes, which really puts you in the position, if you're trying to time the market here, of do you want to risk not being able to refinance at all because you got greedy and you tried to hit it perfectly on the bounce? Or are you okay with a sense of dollar cost averaging, where you refinance and locked in a savings, and then you gave yourself the option to improve it even more if they keep coming down, versus if you try to wait all the way to the bottom and it never hits, now you might not have the option to refinance. That could be an incredibly expensive gamble that you just took. Is that something that you've seen people kind of burn themselves trying to be a little bit too perfect?
Absolutely. And I love that analogy of dollar cost averaging, because that's basically what it is. You're dollar cost averaging into the lowest rate you can get, right? And if you, like I said, if you're sitting at a 7.5 or 8% right now, it makes sense to go buy some 6% Apple stock in this analogy, right? Like, get your average cost of borrowing lower. And if it goes down to 4, 5, 3, whatever we get to at once this Fed cycle is done, cool, go get that. But like David said, you run the risk to, who knows, we go into war or there's a new election, who knows? We're in such a weird, volatile time in our country's history right now. Maybe rates don't come down much further and you locked in a 6% when otherwise you would have been sitting at an 8. That's still a win, right? That's a huge benefit from where you were. And there's some significant savings. You guys can put it in a calculator. What is, a $300 savings for 30 years, $300 a month, that really gets somewhere over time, right? And it's like, at the end of the day, I saved whatever, 30, 40 grand. That's still a win. Oh, but I could have saved, $5,000 more. Like, come on, you also could have not saved 30 grand.
Yeah. It's a asymmetric bet here. You could have got a little better, but you definitely did more. Another way to look at it, if your rate's at 7.5 and you refinance into a 6 and you're saving $500-$600 a month, whatever the case would be, you're not going to be mad if it drops from 6 to 4.5 and you get to refinance again. It's a gift from the refinance gods. You will not be pissed because you had to do this twice. You will be very happy that you got to do it twice. It's not guaranteed that they're going to keep going down. You're just kind of setting a belay so that if you fall, you're safe, and then you have an opportunity to set it in an even better opportunity. I've been in this situation before where I've refinanced and rates went down and I refinanced again. It's a little irritating that you're like, well, if I had known, I would have waited, but you never know. I've also been in the position where I didn't refi and then rates went up and you're left like, damn it. Right. Like now I can't refinance. I am stuck here.
6% and 4%.
That's exactly right. Like you are now at the mercy of the Fed dropping the rates, hoping that you can react. So here's the moral of the story. Don't let your ego get the best of you. Don't let pride stop you from making a smart financial decision because you want to go brag to all your friends that you timed it perfectly. Make the smart move, play the long game, continue to make small decisions that put you in a better financial position, like refinancing into lower rates. We saw a lot of people, Christian, that when rates went up, they were able to get better deals on their properties. And all the rest of the community was saying, why would I buy? Rates are at 8. Rates are at 8.5. Some of the properties I have, they're at double digits because of the situation that I was in when I had to refinance there. But the price on the real estate was really good. The rate just sucked. Well, all these people criticize them for getting a high rate. Now we're getting these people with rates in the 8s, refinancing into the low 6s, or if they want to buy the rate down, maybe even the high 5s. They look like geniuses because they bought the real estate at a really good price and then the rates came down.
Literally have a few of them processing right now. They got seller concessions and they were able to keep their contingencies and they got all the things of like a buyer's market, right? They were able to negotiate the price better. And now they're sitting on, it's not to the severity that it was in COVID, where people were sitting, people who bought in 2018 were sitting on $300,000 in equity 12 months later. But still, people are sitting on $40,000, $50,000, $60,000 that they didn't have to go, tippy top, where it wasn't really in the buyer's favor, where, they had to take this high interest rate, but now they got the price that came at the high interest rate. And now they're getting the interest rate 6 months later. We're literally refinancing 8% rates to 6% right now. Exactly. This isn't like this is some theoretical talk. Like David and I are doing this right now for clients who took our advice, went and bought when rates were high, got a good deal, got seller credit, didn't have any closing costs, and now they're getting the 6% rate as if somebody bought today, right? And without the competition, because I promise you guys, this trajectory continues and we get into the 5s and maybe start to sniff into the 4s. Buyers are going to be everywhere again. It's going to be COVID all over again. You're going to have to waive your contingencies and you're not going to have any deposit, seller credits. You're going to have to put massive deposits that you risk losing. Like it's going to be a bloodbath again, right? And all the people who just ate the 8% rates are going to have the same interest rate as you, right? Because they're just going to refinance, but they didn't have to pay the purchase price you did, right?
There you go, folks. It's simple, it's smart, and he's where you need to start. Christian, where can people go to find out more about you?
Absolutely. As always, guys, you can find me at TheOneBroker on Instagram. Drop me a follow, post content all the time. You can also find more about our company at TheOneBrokerage.com.
And if they want to email you directly, what's the best way to do so?
Yeah, best way, direct work email, guys, Christian, just spelled like my name, CHRISTIAN at TheOneBrokerage.com, same as our website.
And do me a favor, if you email and you don't get a reply back, it could have went to spam. It could have got lost because during a refi boom, it's very easy for emails to get lost. So keep emailing, or you can head over to davidgreene24.com, check out my website. There is a chat feature there that will go directly to my cell phone. So if Christian didn't get back to you, if we missed an email, give us some grace, send me a message. It's not that we don't care. It's just that it slipped through the cracks because, like I said earlier, real estate tends to move in feast or famine, and it's very easy to miss this. We pride ourselves on giving very good customer service. So I promise it is never intentional. We want to help you. You want to help us? Send this video to somebody that you know. Make sure you like it and make sure you subscribe to the channel and keep an eye out for future episodes of Mortgage Monday. Thanks, Christian.